we have Felicity Heffernan and Paul Zalitis in the call to talk about more than one way to finance a house. Felicity, would you like to introduce yourself first?
Yeah, hi. Felicity Heffernan, mortgage broker and also the author of book Extraordinary Property Investing. I've been in the industry since I think dinosaurs roamed the earth. Anyway, no, I've had probably 40 odd years in finance. So I've been a property investor for a good decade of that 40 odd years. And in that time, I managed to acquire 151 properties, which is what I actually based the book on. So there was some good, bad, and some ugly in all of that, and but mostly good. So certainly learned a lot, and out of that, I've been able to sort of pass that on through the book, and that's so. Yep, and there is plenty of ways to skin a cat in terms of property investing.
Wow, 151 properties. I hope I had that portfolio.
So,
I'm eager to hear about your book afterwards. How about Paul? What do you do?
Hi, I'm Paul Zalitis, the Aussie Rapper, helping mates create wealth through property vendor financing. Since the launch of the Aussie Rappers YouTube channel, we have made 12 videos to help you understand property vendor financing better. Today's video is to give you clarity on ways to finance a house. I've invited Felicity Heffernan, CEO of Property Loan Advisor, and author of Extraordinary Property Investing, to chat about mortgages and loans. Also to give you a perspective on vendor financing. I must add that today's information and opinions do not constitute investment or financial advice. Please contact one of us if you have further information.
Yeah, that disclaimer is important. We are not doing financial advice in this video. Felicity, with the current lending situation right now, and if I want to get into property investing, how difficult is it, to get a loan to buy a property for investing? What advice would you give?
Well, it's definitely harder nowadays to get a loan. I mean, certainly when interest rates were, 1% and 2%, it was definitely a lot easier and harder to get in. But at the same token, lending is also becoming easier in the sense that as interest rates go up, banks are moderating their policies. So particularly for self-employed, there's some very, very good things that have come out for the self-employed. If you're PAYG, that's somebody that works for an employer, look, if you've got the income, and it doesn't matter whether you're self-employed or you're PAYG, you do have to have the income to support a loan to buy property. Now, a lot of lenders, they do shave all sorts of things in the property investment world. So, and rental income is the thing that they shave 20% off. So that, you can, on paper, you can have, according to the bank, what you may have a positively geared property, but by the time the bank shaves the 20% off the actual rental income, you, in their calculator, are looking like you're running negative, which that then reduces the ability for you to sort of borrow for more properties. The other place that's that they're shaving is the actual return. So a lot of banks will cap the rental return at 6 or 6.5%. The odd lender out there that will, if you've got a 9% return, will accept the 9% return, but then, you're sort of offsetting that with probably higher interest rates because they're accepting that risk. So they're the two main impacts in terms of borrowing for rental property. I guess the other thing is in terms of buying rental property, it's I guess it's just how much do you actually earn then? So but now I'm seeing, just even with just standard ordinary loans, and people with one or two investment properties, where they're really struggling is we've got the cost of living pressures. So when I look at an individual or a family's living expenses, which banks refer to that as the HEM, the household expenditure measure, I'm surprised to sort of see a family up around $4,500 a month just on living expenses in a bank calculator. So we see all that sort of, when that gets put, all that information gets put into a bank calculator, you can start to see why it can be difficult to acquire a lot of property. In terms of my experience when I went through, it wasn't any easier, because I still had to have the income to support the properties, and when I didn't have that, I then had to seek private financing. So I went out and raised money that way to buy lots of investment property. So that's basically how I did that.
You mentioned that self-employed people, it's now easier for them to get a loan. Are there any criteria that will qualify them for a loan?
Well, yeah. So traditionally, for self-employed, you would have to provide the bank 2 years worth of tax returns, and if you're a company, it will be 2 years of the financials of the business as well, and then there will be a whole long calculation as to loans that were sort of running through the business, and depreciation and interest, whether or not you could add all that back, and that becomes quite a complicated process, and trying to prove whether or not the self-employed person had income to service the loan. And of course, we're always competing with the accountants, who will try and legally write down somebody's tax so that they're not obviously having to pay as much tax as perhaps the tax department might want them to pay. You've got self-employed with tax returns, with all sorts of business expenses running through it, and so at the end of the day, if a self-employed person can really sort of look like they're not earning too much at all, which when they present that paperwork to me to try and get them a loan, that becomes difficult. But the changes that have been made, which I think has been fantastic, is a lot of banks are leaning towards directors' wages policy. So what that means is, if you're a director of a company and you pay yourself $100,000 a year, then all you got to do is show the bank that you're drawing a salary of $100,000 a year, and it makes it just as easy to qualify for a loan as somebody that's actually employed earning $100,000 a year. So we take away all that complicated stuff to try and prove whether or not a self-employed person can get a loan. So, and that's been a really big, I think that's been a great thing, because the only other way to do it was through a low doc loan, which then was quite a bit more expensive than the traditional investment loan that you could get with providing all your figures.
Okay, I mean, that's interesting to know. So Paul, for you, your kind of clients that you're looking for will be actually wider if the the loans are easier for them as well, right, to buy property?
Yes, absolutely.
Yeah. So Felicity, why would people come to you or mortgage brokers for investment loan or a home loan rather than going to a bank?
Problem is, once you sort of get past the first loan, as you can imagine, things start to get a little bit more complex. All right, a branch may be able to handle an owner-occupied home and an investment property, but it starts to get a little bit more complex, once you keep adding investment properties to that. Most people, 70% of people now prefer to work with a broker, simply because you can walk into a branch and of any of the major lenders, and you may or may not get somebody that can assist you with what you want to be able to do. So to cut through all the all the hassle, most people prefer to work with a broker, because now whilst that they may walk into a branch of one of the majors and they may get exactly what they're looking for, it could be just a fluke that they were able to get it done with the best interest rate and all the rest, or they just take what, or they could just get, a decline or whatever, because their requirements and objectives couldn't be met by that lender.
Felicity, you mentioned that you started with finance since dinosaur times, and I'm sure during that time you would have heard about vendor financing.
Yes.
Okay.
Well,
great.
I did. That was the strategy I chose to grow a property portfolio, was to use vendor finance. And the reason I liked that strategy was because I could have as many houses as I could manage, I guess, and they're all positive and they're all spinning off cash flow. So it made sense to acquire as many properties as I could with as much cash flow. And when you've got significant amount of that, it does spin off several thousands of dollars every month in cash flow. Now most people say, oh, well, that's quite a passive income. Well, it still required management. It still required me to chase people that didn't pay. It still required me to produce statements and all sorts of things. So as much as I would have liked to have said, well, I sat on the beach and sipped on a cocktail for a decade of my life, collecting thousands and thousands of dollars of cash flow. No, that wasn't quite the case. No, I did actually have to work for it. However, it was something I really enjoyed, so it didn't really feel like work.
I think for any job, right, where you want to earn money, you have to work for it. You have to work for money.
Oh, you do, absolutely do. Yeah.
Interesting that you say that vendor financing is something that you endorse, and this is what Paul does, right? So Paul,
yes, correct.
You go to someone and say, you should be doing vendor financing if you have buyers who want to buy your property, but they either can't get a loan for some reason, and you become the bank. As the vendor financier, you become the bank, right? So how does that work?
Well, it works exactly as a wrapper is a person that buys the house, purchases the house, and then I'm looking for a wrappee, which is the person that I've on-sold it to, the person that can't get a bank loan, whatever reason it is. They haven't got enough deposit to go to it through a normal bank channel, through Felicity or a bank, and then it's an institution. If they're sick and tired of renting, they've got enough deposit, but they want to get into their own home. They're not tenants; they're going to be home purchasers. So this is a way to make it a lot easier to get into their own home.
So, Felicity, from your experience as a wrapper, the vendor, are there things you need to do? I mean, you mentioned about managing, the property and the payments and all that stuff. But if someone were to come in new, what advice would you give them?
If somebody wanted to take on the strategy of doing vendor finance, Yeah. Well, certainly they need to get some education on it. Look, I don't believe that, perhaps sitting through a weekend course, and, during my time, I saw a lot of people get very excited. They'd come out after a weekend and decide, yes, well, let's go out and we'll do the vendor finance strategy. And they really needed to be mentored throughout that whole process. And it's pretty much like anything. You need to do an apprenticeship in something. Just because you hear of a great idea over a weekend doesn't necessarily mean that you've got all the skills to go and manage it. So, and the biggest issue was for a lot of people were that they had a house. They thought, yep, well, I want to put somebody in to buy it because that way I can make my payments. My payments will be higher than my loan, so therefore I've got a positively geared property. And that sounds like a fabulous idea. Well, the problem is if you put somebody in there and you don't qualify them correctly. A classic example would be, somebody that may have been on Centrelink or something like that. And, if you hadn't correctly verified what sort of income they could afford, very, very quickly that ended up in a big disaster. And there was many people that just did that. And that happened at a time when there was no regulation in the industry. Regulation tends to follow when you've got a huge surge of people going out there doing that sort of stuff. And if you've got impacts on consumers, and consumers are not really aware of what's happening, although you sort of think, if you said to somebody, can you afford a payment of X amount of dollars, perhaps one could assume that that person could say, yes, I can, and confidently move forward and pay it. But that's not the case. I think people would get excited about owning their own home, and if they weren't properly assessed for meeting the repayments, could quite easily fall into a really nasty situation where the house was taken off them. I mean, it's a bad situation for everybody around. The person that loses the house, the person that's set up the deal, it was just an ugly. It is an ugly situation when you do that, and that's just a case of somebody not qualified even just at that point. But then how do you deal with somebody that has a life event and say they're sick and they can't go to work? Well, then you've got to be able to manage them through that process. And if you're not skilled in perhaps managing people through hardship and all the rest, again you've got a nasty situation on your hands. So I do think that if anybody is going to do it, they really need to sort of perhaps, consider a long-term or, perhaps a 1 or a 2 year mentoring with somebody that can actually take them through the process and say, well, look, this is how you do qualify somebody, and you need to be able to, do this, this and this. And also too, if something happens during the first, say you've got the house set up for the first couple of years and you're being mentored, you've always got that person that's skilled sitting in behind you to sort of help you get through a nasty period. Somebody, as opposed to somebody that's just gone in for a weekend and quite clueless about, all the pitfalls. I just think they really do need to be mentored through a process.
That's where Paul comes in, right?
Correct.
Paul,
Absolutely.
you're a coach for vendor financing, and in your last few videos, you did talk about, step 1, to do your research, how to get a rappy or a buyer in, and then step 2, you talked about how to buy the house and how to wrap prep the house and what are the legal aspects to it and all that stuff. So tell me, as a coach, what is your process in getting someone ready for vendor financing?
Well, I'm looking to coach some property investors keen to learn the ropes of property vendor financing so they can build positive cash flow and help buyers achieve their dream home. First thing they should do is go to aussiewrapper.com.au, download the ebook, Positive Cash Flow Property Investing Secrets, read it and check out my blogs and videos, or better still, contact me through my website.
Felicity, I want to go back to your book that you wrote. Can you tell us? I think it's called Extraordinary Property Investing, right?
Yeah, extraordinary property investing. I really struggled to actually get a title for that, but anyway, I landed with that one, and I think because most people see that sort of having 151 properties would be a fairly extraordinary thing to do. So I chose that title. But yeah, so with the book, I wanted to just sort of share the journey of a property investor, right from, like, I have an idea, I want to property invest, so what do I need to do? And so I set up a framework so that they could work through a framework. And I often, sort of say to people, even if they grab the book and they only just sort of read the first few chapters on foundation, and if they stopped there and never went out and did property investing, they'd certainly have a very, very good foundation for their finances and could do extraordinarily well, just sort of getting their finances set up in such a way that they literally really do not have to worry about money again. And that's the key to being a good property investor. You've got to have that foundation sorted, because if that's not sorted, and let's just say you're already financially stressed and you decide that you're going to have a brilliant idea and go and buy a property a property for investment because you want to improve your finance situation, I'll guarantee you that'll be the fastest way to go down the gurgler. You've actually got to have the foundation set up correctly and have your own house in order before you start creating additional income through this means, because again, there's a lot to manage. And if you look at the framework, well, then there's 3 other sections there that and that they are for the property investor. The first one is really for anybody, but the first one is probably the most important one for a property investor to go and get started. So basically, once they have their house in order, they can then start to look at acquisition. Now, in acquisition, you're looking at really that's your research phase, and you're out there and you're seeing what is available. You're seeing what is what prices are. You're probably talking to someone like Paul and getting some mentoring, and you're probably doing a lot of scenario type work. And then after you've done all that, that's right at the end of that acquisition stage is that you would have actually acquired a property. So that's great, you've acquired it. Now what do you got to do? You've got to manage it. And there's a whole section in there on actually the possession. I call it possession, but really that's once you've got the possession of the property, you've got to manage it. And then how do you do that? Do you outsource that to people that can actually assist you? So whether you've got a vendor finance property and use a specific vendor finance manager, or do you manage it yourself? Or if you just got a regular investment property, just earning standard rent, do you use a property manager? And basically the book goes right through all the different ways that you can actually do it. Yes, you can do it yourself. I myself do like to outsource the management, particularly of what I would call standard rentals. I did manage my own vendor finance once, but I was sort of a little bit ahead of most people when I started. I think I probably would have been one of the first pioneers of vendor finance in this country. So there wasn't anybody when I started that could actually manage the properties. But probably if I had my time again and there were those people, I'd probably employ them to assist me in managing the property, because I did actually find that to be the hardest part. So then we sort of get to the last part of the framework, which is the accumulation. It's like, all right, well, we've done that once. Can we create a cookie cutter out of it? Can we, do that whole thing again? And really at the accumulation stage, it really goes into really your psychology, your mindset. How are you psychologically set up to do this? You might find you get the first house and you've had a fantastic experience, and you're feeling 10 foot tall and bulletproof, and it's probably a bit of a dangerous time, because then you might say, well, you know what, I've done it once, I've learned everything I can do from Paul, but really all you've done is you've just had a great experience. You haven't experienced the downsides, the life events that people may get themselves into, and if they happen to be in your property, you've got to be able to manage them through their hardship, and that's probably where you need your coach at that point. Probably don't need your coach when everything's going swimmingly well, but my gosh, you need your coach when things start to fall apart. So to get back to my example of things have gone swimmingly well on that framework, and you've got to accumulation, you go, well, that was easy. I'll ditch Paul, I'll save myself a little bit of money, and I'll go and do it again. Well, you get to the second property, and it may not be the property that went as well as the first one. And so that's kind of, you really do need to keep your coach until you're well and truly on your way, and you've started to experience everything, well, not everything, but you've started to experience a good number of things that actually can go wrong. Because I'll guarantee you, someone like Paul has probably been through it all. Yep.
For sure.
Yeah. And you need someone that's been through it all, because you don't want to have to figure it out when it's gone wrong. You don't want to have to sit there and figure out, oh, geez, now what do I do? And you do have to be in a position, if it's gone wrong, you're going to have to keep funding the bank payments. Otherwise, your personal finance situation is impacted. So once you've sort of done that, you've gone round that first wheel, you come back to foundation again, and you're constantly reviewing your own situation first. Now, do I have enough money, or do I acquire the next one, and then I've absolutely got no funds whatsoever? So in other words, if something goes wrong and somebody misses 1 week's payment, and you can't even afford to prop up the loan for a period of time, well, then you'll find your own personal situation will go down very, very quickly. So this is about having working capital. Be no different to any other business. Like even my mortgage business, I'm always making sure I've got capital available, because I can't guarantee that a settlement will come through on time, or worse still, in our industry, we get clawbacks anywhere up to 2 years if the loan does not stay with the lender. The only industry I know that you can get paid nothing for working, 20 hours on somebody's loan. So that's I'm having a whinge about that. But the point is,
that's all right.
The point is, I guess that's my equivalent of somebody else in a different business where they don't get paid for something. And when you don't get paid, you have to be able to maintain all your own commitments. So as you come around that 4-step framework and you're back at foundation again, you're back at reviewing. Okay, well, can I, have I got the money now to go and do the second deal? You need to be able to make sure that you've got, funds in case you hit a rainy day period or a life event where, your significant other might have had an accident and can't go to work, or if there's kids involved, somebody might have to take time out to do all that sort of stuff. So you've really got to plan for the life events. And look, you might be lucky and get through life without, get through life when you're relatively unscathed. That'd be fantastic. But in my experience, as the more properties I had, the more problems I had. But then, you're on this planet to solve problems. And you're alive when you've got a problem to solve.
Thank you for sharing the good, the bad, and the ugly.
Absolutely.
Yeah, I hope it was. I hope it wasn't. It was. I hope there was more good rather than ugly. But look, it's just. It's ugly. You've got to. I guess you can't sugarcoat this. If I was perhaps flogging a weekend seminar and wanted to make a whole bunch of money maybe for a weekend, I could probably sugarcoat it a bit more and sell my wares that way. But no, look, if you go into this, you got other humans you're responsible for, and you got to think about them. And there could be some little baby humans in there that you really don't want to be. You don't want to be in a situation where you're evicting them and getting them out on the street. That's the worst thing. Now the reality is you may have to do that one time, and that is not a pleasant thing. So I guess when I speak about the ugly, it's just be aware, there's human beings involved, and we're all humans and we're all got to live on this planet, and so you've got to do the right thing by other humans.
And like you said earlier, right, that research, and Paul, you mentioned that research as well so many times, in setting that foundation that you talked about, facilities, set it all right before you go out, buy the house and start wrapping it and whatever. Yes. And that's where Paul comes in as the mentor and the coach to make sure you are set up correctly so that ugly situation that may happen, right? So we want to minimize that, and that's where Paul comes in. So Paul, do you have any comments on what Facility was saying? Success stories, not just bad and ugly.
No, I think, as I said, research, and even before research, I always maintain in my manual, in my coaching, and what I say is you do not and you cannot wrap a house unless you can afford that first mortgage. You've got to be able to afford that first mortgage, as Felicity was saying, because if you can't, and you can't pay the bank, which is the money that you borrowed off the bank, if you can't pay that first, forget about doing vendor finance. So you've got to be cashed up, you've got to be able to get a loan, you've got to be ready to go to purchase a house through research, through my mentoring, which I love doing, as Felicity knows, she's done a lot more than I have. But the research and talking to people, getting out there, and she's made this beautiful comment, wear out the shoe leather. Get out there, talk to people, knock on their door. If there's someone watering the lawn or mowing the lawn, just say, "G'day, how you going? Is it good to live here? Is it nice? Is it a good area? Is it a bad area?" Blah, blah, blah. Get all that information. This is where I come in, and this is what I love to do, is help mentoring people from go to way.
Yes, Facility, there's one question I wanted to ask you. If someone, whether an investor or just a home buyer, wants a loan and seek a mortgage broker and want to come to you, how do they find you?
Oh, well, that's a very good question, and they should seek me out always. So they can find me at www.propertyloanadvisor.com.au. We do specialise in working with property investors. but also to the self-employed. I do like that space, being self-employed myself. I do have a soft spot for the self-employed. So so the website's there. Certainly, you'll sort of find me on all the socials if you go searching my name. Definitely, if you want to book in for an appointment, just to have a chat about your situation, particularly sort of, like probably after you've spoken with Paul and gone through perhaps all the foundational things that you're doing through his mentoring there. Probably the next step is to then speak to someone like me and get some advice on setting up your loans. There is, structuring your loans is very important because, yes, it's one thing to get a loan, but to have it structured correctly, because you want to be able to have your investment loans separated from your owner-occupied loans, because there's probably a lot of tax benefits and things like that, so even though you probably could, you might have money in your redraw to pull out and buy an investment property, you've got to question whether or not that's the right structure to do that. So you might want to talk to a mortgage broker, get that set up correctly. I'm a big fan of just having everything separated nicely so you can hand the statements over to your accountant. And so your accountant's not sitting there scratching their head going, well, what's investment here and what's owner occupied, or better still, probably the way they're talking is what's deductible and what's non-deductible. So having it structured correctly so that you can sort of see it, hand statements over the accountant. I'm all about the simplicity of it. So you set it up right, get it done right in the first place, and then that you've made life easy for your accountant, because your accountant needs to be able to squeeze out every cent that you're entitled to. So no point having your accountant pull their hair out whilst they try and figure out where the tax deductible expenses are.
So for Paul, any property investor who wants to invest in another property, they should also think about vendor financing. So how do they come to you?
They come to me through www.aussiewrapper.com.au. That's my best website. It's all on there. As Felicity said, I'm on all the socials, and I'd love them to come to my website, have a look at everything, download the free report, get a lot more information. They'll also contact me through email and through my phone.
Okay, that's great. Thank you so much, both of you.